Near quarter end, a US industrial distributor reviews its new AI operating system. Route planning is cleaner. Inventory errors are lower. Administrative work has been reduced. On the internal P&L, variable costs are moving down. Then the pricing report arrives. Two competitors have made similar investments and now offer lower contract rates to defend volume. A third has not fully automated but is discounting anyway. The cost advantage is still present. It simply no longer sits safely inside the margin line. This pattern reflects the competitive cost compression effect. Under US market conditions, AI-driven efficiencies rarely remain isolated. They propagate through pricing dynamics, reshaping gross margins across the competitive field. Many organizations initially approach AI adoption with a straightforward assumption: lower variable costs, achieved through better forecasting, automated decisioning, or process optimization, should expand contribution margins and improve operating leverage. The logic appears sound on paper. In practice, the economics reveal themselves as more constrained once competitive response enters the equation. A lower cost base is valuable, but value does not automatically remain where it first appears. To make the underlying relationship legible, consider a simple economic schematic. Picture the pre-AI industry cost curve sitting at a certain level relative to prevailing market prices. After widespread automation, the average cost curve shifts downward. The immediate headroom between cost and price seems to promise margin expansion. Yet the price line itself begins to adjust downward in response to competitive moves, compressing the margin stack for all participants. The cost curve moves first. The price line follows. This relationship holds across many US sectors where products or services carry limited differentiation. The mechanics are straightforward yet frequently underestimated. AI systems can genuinely compress certain variable costs, reducing error rates in fulfillment, optimizing pricing in real time, or streamlining administrative workflows. For the early mover with limited legacy system drag, this can create temporary breathing room in the P&L. Quarterly reporting pressures, however, change the calculation. Firms cannot easily absorb the optics of holding higher prices while rivals pass savings to customers. The incentive to match or undercut accelerates. The advantage narrows. What appears as proprietary efficiency often becomes the new competitive baseline once multiple players deploy comparable capabilities. The gain is real. The capture mechanism is unstable. Legacy integration realities exacerbate the issue. Incumbents running parallel systems during high volumes of concurrent AI pilots frequently find that total cost compression is less clean than initial projections suggest. The visible labor or process savings are real, yet they coexist with new infrastructure and oversight burdens that behave more like semi-fixed costs in practice. This compression dynamic proves particularly pronounced in markets characterized by high transparency and relatively rapid imitation cycles. The advantage narrows at the moment the customer can observe it indirectly. One department achieves automation gains, while adjacent functions carry integration overhead, making firm-wide margin improvement fragile. The economic model tightens considerably at this point. The system lowers costs in targeted layers of the operation, but it simultaneously equips competitors to adjust pricing aggressively, shifting the benefit from margin expansion to volume defense or share maintenance. The company lowers cost in the visible workflow. The market lowers price against the entire business. The net P&L impact depends not merely on internal execution, but on how quickly and completely the competitive set adopts parallel efficiencies. In concentrated or commoditized US markets, the result often favors customers through lower prices rather than producers through sustainably higher margins. Second-order effects add further precision to the picture. As industry costs compress, some participants pursue higher volumes to protect absolute profit dollars, increasing capacity utilization requirements and exposing the model to demand volatility. Vendor dependency or API reliance can introduce new cost stickiness. Data requirements for continuous model improvement represent ongoing commitments that resist easy reduction even when competitive pressure intensifies. The efficiency appears scalable on first examination. It proves conditional on factors that markets rarely sustain: delayed competitive response, persistent differentiation, or pricing discipline under quarterly performance scrutiny. Margin improvement in the cost layer quietly relocates pressure to the pricing layer. In capital allocation terms, the real risk lies not in pursuing AI efficiency, but in underwriting the projected savings as retained margin before the market has had time to propagate the reduction into pricing. Under quarterly pressures, initial gross margin expansion in the financial statements is frequently followed by pricing concessions that stabilize at a lower equilibrium. The compression becomes visible precisely where the model assumed the advantage would remain protected. Over repeated quarters, competitive cost compression reshapes category profitability structures. Operational success and margin capture are not the same result. The efficiency remains inside the system. It just stops belonging fully to the firm that created it. It does not eliminate the value of AI efficiency. It does, however, constrain where and how that efficiency accrues in the financial statements. Sustainable outcomes favor organizations that anticipate the propagation of cost advantages and position accordingly, often by focusing automation where it creates value beyond pure cost reduction. The savings remain real, but the market determines how much can be retained, how much must be conceded, and how quickly the baseline resets. The cost advantage does not disappear. It travels from the operating model into the price line and settles inside the new margin baseline.